So good evening, comrades, and welcome to part 5 or part 4B of our training. And today we are going to continue to look at money in the financial systems. Allow me to welcome Comrade Garikayi, who is going to lead us into this discussion. So welcome, Comrade Francis Garikayi, and may you please take the floor.
Thank you very much, Comrade Tasa. I really appreciate you asking me to do this. And hello, everyone. Today, I'm going to speak to you about money in the financial system. My name is Francis Garikayi, as has already been said by Comrade Tasa. So this presentation is divided in two parts. The first part is going to deal with the definitions of money. And this is something that's already been covered in the last session, but I'm going to quickly go through some of the concepts that I think will be essential for us to then delve into the global financial system. Let me then kick off by reading out a quote from a book by Adam Smith, his magnum opus, The Wealth of Nations. Labor was the first price, the original purchase money that was paid for all things. It was not by gold or by silver, but by labor that all the wealth of the world was originally purchased. I think this is a very important citation to make, especially in the context of a presentation to workers. What then is money? There are many definitions of money. And money, what role does money play in society? What is its function? And what forms does money take? There are different schools of thought which differ in the way that they understand these questions, that they answer these questions, as well as in fact, the differences are in the way they ask the questions, as well as in the way they provide the answers to these questions. For this presentation, I'll be focusing on Marxist theories of money. Let us look at the functions of money then. In mainstream economic thought, money is based on its functions, and it's said to have function in three ways. One is a medium of exchange. So if you want to exchange something for something, then you have to use money as a unit of account and as a store of value. As economics as we know it today is not a uniform discipline. So there's what we call neoclassical economics, and there's some branches of economics called post-Keynesian economics. And there's also Marxist economic thought. So these schools of thought differ in the way that they define money, or the way that they understand the functions of money. From a neoclassical perspective, the emphasis is on the function of money as a means of exchange. So here the view is that markets and money are intrinsically related with the latter spontaneously appearing as a result of the former. So money is said to, the view is that money appeared because of markets. And then in neoclassical economics, money is neutral in the long run, the so-called quantity theory of money, which looks at money as, the quantity theory of money says that the goods and services, money supply determines the goods and services that are available in a society. And then we have post-Keynesian economics, which focuses on a fourth function of money, which is the focus on money as a means of payment. And there's a stress, in post-Keynesian economics, the stress is on the non-neutrality of money. So in post-Keynesianism, there's more emphasis that money is not a neutral agent, or agent in the economy. Let us now look at a Marxist view on the origins of money. In Marxist theory, the origins of money lie in commodity exchange. You will remember from the last session that we said commodities possess the form of value. While all commodities possess use value, in other words, commodities are useful, capitalist production is unique in its production of exchange value. Exchange value is the quantitative aspect of value. It is the exchange value of commodities that can be brought into equivalence, compared as magnitudes of value. Money appears in a capitalist economy as the universal equivalent. In other words, a special commodity that possesses the general relative form of value. For Marx, money is constituted by social relations among commodity owners in the course of trade. And the essence of money is that it resolves the contradiction that commodities simultaneously embody use value determined by the individual valuation and socially determined exchange value. So use value of a commodity, remember, is whether that commodity can have some meaningful use to someone, or that you can eat it, or you can use this to satisfy needs and wants. And then exchange value is the value of a commodity that is more important to not only you, but to others. And that is determined by society. If we look at the development of exchange value and how it crystallizes historically, we see that it has gone through some sort of stages. When in early societies, when commodity transactions were sort of accidental, there was an arbitrary or intransitive equivalencies that prevailed in those societies. So for example, if you had 3 apples, you could exchange them for 2 oranges, and if you had 1 orange, you could exchange it for 1 lemon. In these instances, there was no equivalence. So 3 apples are not necessarily equivalent to 2 lemons. It was sort of barter society where people just used to exchange arbitrarily. However, when trade expands to the extent that it becomes generalized, we start to see exchange value more developed, and equivalences are now less arbitrary and more intransitive. Intransitive simply means related to a particular object. So here we start to see that 3 apples might be equivalent to 2 oranges, and 1 orange is equivalent to 1 lemon. Therefore, 3 apples are equivalent to 2 lemons. Now, when commodity transactions reach the money stage of exchange, we start to see that exchange value becomes consistent and mutually compatible. Money prices among commodities. In other words, commodities are now priced in money terms. A situation where you have, say, 1 apple is equivalent to $1, or 1 orange is equivalent to $1.5, or 1 lemon is equivalent to $1.5. So this is the stages that we go through until we get to a stage where we have something that we call money. As transactions take place through the stages, a single commodity wins out as the universal equivalent, monopoly over the ability to buy and represent value. When a commodity can be used to buy others, it acquires additional use value based on this ability to command the purchase of other commodities. But don't forget that money is also a commodity. Value appears as exchange value, common to all commodities in the body of the universal equivalent. Universal equivalent, in other words, money, is a commodity that is directly exchangeable for all other commodities. It embodies the general form of value and is the fundamental form of money in Marxist thought. That's how money is understood in Marxist thought. There are other views of money, as I said, neoclassical or post-Keynesian. Then we might then ask ourselves, why does a particular commodity appear as the universal equivalent? Well, there are 2 types of properties that usually make those commodities appear in that way. Firstly, we can have the physical or material quantities such as durability, homogeneity, divisibility, and ease of transport. So, gold is homogeneous and you could mint it into coins, silver, and the other issues might be specific origins of commodity exchange and trade between societies, social customs. Here we can talk of cowrie shells. They were used in other societies as means of exchange. And then here it's important for me to also cite Marx where he says the particular kind of commodity to which universal equivalence, in other words, money, sticks is at first a matter of accident. The money form attaches itself either to the most important articles of exchange from outside, and these in fact are primitive and natural forms in which the exchange value of one product finds expression, or else it attaches itself to the object of utility that forms like cattle, the chief portion of indigenous alienable wealth. Remember, you might recall that in the past, cattle was an important commodity for exchange amongst societies, even in our own, well, at least I'm from Shona. I think I'm from Shona. I don't quite know though. Would use cows for marriages, and it's still ongoing today, So this is how a particular commodity might appear as the equivalent, as the universal equivalent, or as money. The universal equivalent, in other words, money, can assume a variety of different forms. This is very important to grasp. It can be a commodity, for example, gold, fiat money, which are the money that's might be decreed like RTGS dollars, banknotes or bank deposits, money trust accounts, derivative contracts, etc., etc. In all its forms, the universal equivalent monopolizes the ability to buy and represent value. So you cannot buy in Zimbabwe, for example, you can't buy if you don't have Eco Cash, if you don't have RTGS dollars, or if you don't have US dollars. We seem to have quite a number of things that we can use there, but that's the universal equivalent. I cannot then come to you in exchange. Well, I might do that, but then I will not be able to go further. The chain will not continue if I exchange my pair of shoes with you for something else that is not these other forms of universal equivalent. So from this now, then Marx derives different forms of money, each related to the functions that it performs. Let us then look at these in turn. Money as a measure of value. This cannot be separated from money as a means of exchange. When a hoard of money consents to a commodity's owner's offer to sell, the value of the commodity is measured for the market as a whole. It is simultaneously a measure of value and a means of exchange. There are no social mechanisms in capitalist society through which commodity value is expressed in money terms independently of the act of commodities being offered for sale. So you can, commodity exchange and money are intricately bound up together. You cannot separate these two as, you know, what the bourgeois economists try to do. And money can be a means of hoarding. Money here can take different forms, but commodity money has different inherent advantages. For example, gold. This is something that you can use for hoarding. Money as a means of payment, different from exchange because it entails the separation of purchase from sale. You're just using it as a means of, of payment. Here, money tends to assume the form of credit money, a promise to pay that performs the functions of money. So if you go to the bank and the bank creates you get a bank loan, the bank will give you the money or gives you the means of payment. If you use it electronically, for example, you have all these numbers that you just use to pay. And then we also have money as world money as a means of international payment. And in international trade, you and I will agree that we don't just use our RTGS dollars. Here, we are now gravitating towards, reserve currency. And in this case, it's the US dollar. Okay, and then there's something that we can call credit money. As already discussed, credit money differs from commodity money, as the former functions as a means of payment, while the latter is a means of exchange. Credit money is created through the advance of credit. In this way, it enters into capitalist circulation. Just to be by mere, a bank just creates money out of nowhere, and then the money is in circulation. There's not been any commodity that's been produced. It's just the ability to sit on a computer because you have that power to just create numbers and then start to allow people to have the means of payment. So there are no commodities involved here. Credit, to the extent that interest acts as payment for debt, is intimately tied to the financing of accumulation under capitalism. That is very important to note as well. There are two types of capitalists if we then look at this in detail. There's the money capitalist who earns an interest in lending money to the productive capitalist for payment of means of production and wages to engage in production to generate profit. So money capitalists, here you have your bankers. I think some of you here are working in banks. They just really are involved in giving money to people who produce things. Could be the miners or whatever. And then their profit is just really comes from lending money. But whereas in the miner actually needs to dig the ground and extract the minerals, or the industrialist needs to manufacture something. Money capitalists deal in interest-bearing capital. So the capital that money capitalists is called interest-bearing capital. Of course, as long as the money capitalist gets his interest payment, he's not interested in whether the money enters the circuit of production. So for as long as you're repaying the loan, the bank doesn't care that you came to borrow money for building an industry. And so this is one of the challenges that we start to face, where bankers have become more dominant than people who actually produce things, to the extent that we end up without producing anything and just people making money through money. Money that engages in production is money capital. Money is capital, another type of money. In other words, money that goes to invest in industrial enterprise to make things that people need and then to sell them. So from a Marxist perspective, money is endogenous. In other words, it simply means that money has an internal cause. In other words, it comes from capital, the processes of capital accumulation within a society. For Marx, the quantity of money in circulation, including commodity money, is endogenously determined as a result of money hoarding, credit advance, and debt settlement. These processes spring from the accumulation of capital, making it possible for the quantity of money to change in accordance with alterations in the price level. Let me now, so I've tried to run through, theories of what is money, different understandings of what money is, its different functions, looked a little bit into credit money. This is important background information that you need to have. And I think if I may highlight one thing that I want you to take away from these first slides, is that you must always understand that the way we understand money is not the same For a neoclassical economist, he has a different view. For the post-Keynesians, they have a different view. For Marxists, they have a different view. It is very important for you to understand those differences and to then choose which theoretical framework works for you. Money is one of the most difficult things to understand in the social sciences. I don't think we quite know everything about money. Right, let me now move into the second section of this presentation. And here I'm now going to talk to you about the evolution of the global financial system. This section is divided into 5 parts. The first part is to give you an overview. Second part, I'm going to discuss the gold standard system, which operated between 1870 and 1931. The third part is the Bretton Woods system, which operated after World War II. And then I'll look at the current system, which is basically could be said is the neoliberal system. And then finally, look a little bit at what the trilemma is. Let us take a brief look at the events that have led to the current financial environment in which we exist. We will thus first begin by looking at the monetary system and changes that have taken place. The modern development of financial risk management, as well as the financial system in general, has its origins in the global financial dislocations that followed the collapse of the gold standard and post-war global structure called the Bretton Woods Agreement. Therefore, an understanding of why these two systems collapsed is paramount in understanding the monetary setting in which we find ourselves. The gold standard system. This system operated between 1870 and 1931. Gold standard functionality, how did it work? Well, nominal exchange rates were fixed at the ratio of their gold parities. $1 US was equal to 1/20.67 of a troy ounce, about 31.1 grams of gold. The British pound sterling was said to equal 1/4 ounces of gold. Therefore, the exchange rate of the dollar for the pound was around £1 to $5. What were the rules of the game? Gold was freely convertible between domestic money at the fixed price. There were no restrictions on the export of gold by private citizens or capital across countries. Banknotes and coins were backed by the availability of gold reserves. Long-run money supply, therefore, was determined by the availability of gold reserves. In other words, if you didn't have much gold, your money supply in the economy was dependent on the gold that you have. And I said you can understand why now people were, say Zimbabweans, we were interested in having such a system, because we thought if we could limit money supply based on the available gold, then maybe that could solve our problems, but maybe not so much. If convertibility of money and gold is suspended, there was the attempt to restore convertibility as soon as possible at the odd fixed price. That's how the system worked. And the system allowed inflation to be determined endogenously by world demand and supply of gold. So that was how the system worked. The system was the product of convention and experience. There was no formal agreement to conform. Money supply was linked to the availability of gold. In other words, this was a system that just emerged out of social relations. So there was no, if a country didn't want to do it, then they could decide to do so. Money supply was linked to the availability of gold. The current account surplus, in instances where you had more exports than imports, you then accumulated gold. And in instances of current account deficits where you had less exports than imports, you had decreased gold reserves. So when you had under a trade deficit, you would have a outflow of gold, lower money supply in your economy, and lower prices. And then your economy will become more competitive, and then until the system gets to an equilibrium. Similarly, if you had a trade surplus, you would have an inflow of gold and higher money supply and higher prices, decreased competitiveness until it reaches to an equilibrium. This auto-correction system was called the price-specific law. You can look at it, at some stage if you want to understand more about it. According to the data, net capital flows tended to be larger under the gold standard. Further, private sectors play the dominant role in these capital flows, which is consistent with the notion that economic fundamentals were at work. Capital tended to flow from Europe to new investment opportunities in the young, fast-growing economies in Asia and the Americas. So the gold standard had good allocative efficiency. Passive monetary policies meant that they did not pose a significant threat to global financial instability. So under the gold standard, the system was relatively stable. So why did it work? There was an internal political commitment to convertibility. So in labor, there were sort of weak labor unrest, but at the same time there was growing unionization, right? And if you look to your right, you can see in 1870 those were the countries that were using the gold standards, the gold-colored ones. By 1902, that was here and it changed. And so there was also free trade and free capital mobility. The leading imperial power at the time was Great Britain. It recycled its surpluses by lending to infrastructure development. We had high stable exchange rates under the classical gold standard, which provided an environment which was conducive to international trade and investment. There was also international cooperation. There was no formal mechanism to force countries to adjust their domestic policies under the gold standard. Instead, this was done out of convention. Today, you're literally forced. Overall, the gold standard appeared to perform reasonably well against its financial stability and allocative efficiency objectives. However, the internal balance objective was of secondary importance. It sort of was outward looking, whereas internally, as we will see, it had different problems. The gold standard record for internal balance was less convincing. For example, the US suffered deflation and depression between 1870 and 1880, and unemployment rate averaged 6.8% from 1830 to 1913, and during the gold standard. And if you compare it under the Bretton Woods latter system, it was much lower. So suspension, the gold standard worked very well from around 1870 to 1914. But then World War I broke out, and the gold standard was abandoned, especially in the conflict-ridden countries. The United States did not, although the United States did not abandon the gold standard. And then exchange rates fluctuated as countries widely used predatory depreciations of their currency as a means of gaining advantage in the world export market. You know, when a war starts, you need material, so competition increases. The result for international trade and investment was profoundly detrimental. And then let's look at the gold standard in World War I financing. War was financed by the abandonment of metal backing gold, increased printing, and increased debt. So, well, before the war, it was okay to just really stick to this convention of saying, okay, the money in circulation must depend on the gold. But, with the war and all the demands that it had for materials, people started to abandon it. More increased printing of money, and then obviously debt. Was this unusual? Not quite. It has been used historically. If you look at the French Revolutionary Wars, the Napoleonic Wars, and the American Civil War. The result of this was high inflation, a severe recession, and depreciated and highly volatile currencies. And then after the World War I, there was an attempt to reinstate the gold standard. It was believed that it would be necessary for economic recovery and stability. But there was the system had a failure of credibility in the system. The UK reinstated the pound at the pre-war rate. The results for the UK were not quite good. It priced UK exports out of international markets. Massive labor unrest in the UK as wage cuts were resisted, and there was increased need for foreign loans. And then how about the US? The US after World War I ran a trade surplus of 20 billion. US outcompeted through war supplies and loads. The mainland was mainly virtually untouched, after World War I. 40% of the world's gold was in the UK after the end of the war, and the US was the world's creditor. And the US traded more widely than any other country. Let's look at the USA in what's been called the USA Roaring 20s. In the US, gold supply used to fund credit booms in stocks, housing, motor vehicles, and consumers. But then the economy began to overheat. The Fed adopted an anti-speculative interest rates from 3.5% in early 1928 to 6% in August 1928. By the time the Federal Reserve belatedly tightened monetary policy in 1928, it was too late to avoid a significant economic correction. In 1929, the US stock market crashed. By the time the crash was completed in 1932, following an unprecedentedly large economic depression, stocks had lost nearly 90% of their value. The demand-driven theories argue that the financial crisis following the 1922 crash led to a sudden and persistent reduction in consumption and investment spending, leading to low unemployment. That's those people who argue on demand-driven, but I think it's really a crisis, a capitalist crisis. Banking crisis increased and people struggled to pay their debts. Many companies went bankrupt, creating record levels of unemployment, and people began to hoard gold. And the economy finally collapsed in the Great Depression. Sorry, I think I duplicated this slide, sorry about that. And then let's look at the statistics during the gold standard and the Great Depression, just to give you an indication of what happened. Changes in economic indicators, you can see them to your left. Industrial production in the United States, you can see it fell by 46%, in Germany by 41%. All the indicators were really bad. Unemployment in the United States increased by 607%, in the UK by 129%, in Germany by 20%. So this was a moment of great economic strife. The effects of this was a period of turbulence in the international economy, which became contagious. And with high unemployment and inflation and hyperinflation even, Germany, countries competed rather than collaborated. Then there was political and social unrest. Against the backdrop of increasing concern about domestic objectives, political disputes over war reparations meant that central bank cooperation was not forthcoming when Germany faced a banking crisis in 1931. In 1931, Britain withdrew from the gold standard, which triggered the global collapse of the exchange rate system. Other countries followed Britain and left the gold standard, including most of the dominions and empire of Britain, British dominions and empire countries, the Scandinavian countries in Canada and Japan. So almost all the countries went off the gold standard. And then on the 3rd of March, 1933, the newly elected US President Roosevelt closed the banks in response to a run on the gold reserves at the Fed. By the time banks reopened on the 10 days later, they had turned in all their gold to the Fed. People could no longer redeem dollars for gold. No one could export gold. You recall that earlier we said, private citizens were just allowed to export gold or to just go to the bank and exchange your notes for gold. France export could no longer compete with UK and USA. And by 1936, France had also abandoned the gold standard. So that was the context, and I think that was the context that resulted in the end of the gold standard. And then we got into, obviously, World War II started, and then when World War II ended, the Bretton Woods system was established in the late 1940s in an attempt to allow countries greater domestic policy autonomy while still insulating them from excessive exchange rate volatility that had been experienced under the gold standard. Policymakers appeared to assign greater importance to achieving internal balance and financial stability and less to obtaining allocative efficiency. You can see in that picture when the Bretton Woods is a place in the United States. It's a hotel that they went to decide for everyone, including Africans, how the monetary system was going to work. I'm not sure if there was any African there, but you can see to your left, that's Winston Churchill and then Roosevelt, I think. And then you can see John Maynard Keynes there in the other picture. So they went there to discuss what to do with the global financial system. Anyway, the Bretton Woods system also marked the coming onto the world scene, or the hegemony of the United States. The United States really was taking over then as the global imperial power. In July 1944, 44 countries met in Bretton Woods. They established the Bretton Woods system. These were like financial system reforms that fixed exchange rates against the US dollar. So the fixed dollar price of gold was fixed at $35 per ounce. How did this work? Under the Bretton Woods Agreement, countries promised that their central banks would maintain fixed exchange rates between their currencies and the dollar. So if it was Zimbabwe, say, okay, we will maintain a fixed exchange rate of $1 Zimbabwean dollar to 10 US dollars. How exactly would they do this? If their currency's value became too low relative to the dollar, they would buy up their currency in foreign exchange markets. This would decrease the supply, which would automatically raise the currency price relative to the dollar. And if their currency became too high, they would print more of their currency, increasing the supply and automatically lowering its price. Why did they choose the US dollar? Well, apart from the fact that the US dollar, the United States was now the most powerful country in the world, the US held 3/4 of the world's supply of gold. After World War II, the United States came out the strongest country globally. Britain had been decimated by the war. Europe was basically collapsed, with all the infrastructure damaged by the war. So the US was basically the most powerful country in the world at the time. And apart from that, they held 3/4 of the world's supply of gold. The dollar's value was then set at 1/35 of an ounce of gold. So in a way, the world was still somewhat of a quasi-gold standard. So although the gold standard had fallen, the Bretton Woods system still maintained some link with gold. Right, what were the implications of Bretton Woods? Well, new institutions were established. The International Monetary Fund at the IMF was created as an integral part of this system, with responsibility for supervising a pool of reserves that could be used to finance temporary imbalances and adjudicating changes to the exchange rate parities. The World Bank was also established at this time, which was responsible for providing basically development finance, because all the countries in Europe had basically there was no infrastructure. So the World Bank was going to form that role of, I'm sure you've heard about something called a Marshall Plan that was kind of reconstructing Europe. And initially the World Bank was called the International Bank for Reconstruction and Development. And then the third institution that was created at Bretton Woods was the General Agreement on Trade and Traffic and Tariffs, which later became the World Trade Organization. What were the logistical implications of this? The global liquidity determined by the supply of gold and the size of US balance of payments deficit. That's when the US became firmly in charge of the global financial system. Capital controls were sanctioned explicitly to prevent speculative activity from forcing premature and destabilizing realignments. As a result, net capital flows were their lowest during the Bretton Woods system. Remember, we said during the gold standards, capital flows were just basically left. There were no capital controls. Capital flows were allowed, but under the Bretton Woods system, capital flows would have to be capped. Assumptions that were made under the system were that temporary credit would be sufficient to transition the world economy from war to peace, and major currencies would be in equal demand roughly, and balance of payment imbalances would be temporary and not structural, but they became structural. Balance of payments imbalances would result from trade, not financial flows. That was the thinking, that balance of payments imbalances would be if you're not trading as good as well, then not necessarily because of financial flows. In practice, this, however, meant that it was underestimated the scale of problem of post-war reconstruction, and there was an underestimation of the functioning of the Marshall Plan, and then dollar shortages, and then most importantly, the US and not the IMF funded the Bretton Woods system. That is still the case. Let's look at the collapse of the Bretton Woods system. It collapsed primarily by imbalances of the US in the 1960s and 1970s, from firstly US military spending, which doubled from 1960 to 1970 during the Vietnam War. Trade competitiveness of the US declined, so Japan became more important and West Germany, and US inflation started to increase from 1.5 in 1965 to about 5.5 in 1969. By 1964, US dollar in foreign banks exceeded all the gold in Fort Knox. Fort Knox is being the gold reserves. So they had sort of, found themselves entangled. Speculation about the devaluation of the dollar caused countries to buy large quantities of gold. So between 1968 and 1971 and 1971, this is what happened. In 1965-68, the Fed attempted to defend the dollar by selling gold. In 1970, US gold's coverage deteriorated from 55% to 22%, such that this left them with no option. On the 15th of August 1971, President Nixon unilaterally terminates convertibility of the US dollar to gold. Let's hope that I can play this announcement by Nixon and that it will share. You can listen to President Nixon's announcement in 1971 that the termination of the unilateral termination of the convertibility of the US dollars to gold. This was obviously agreed at Bretton Woods, but the Americans simply said no. 1971, we are canceling it. So for the first time in 2,500 years, gold is demonetized. So in 1971, gold had, for some, in one way or the other, been an important or integral part of the monetary system. So it was officially demonetized in 2,500. This is why whenever we hear things like gold coins, or that you hear from people saying, oh, we are going to do this with gold, Zimbabwe must do this with gold, I think it is really being ignorant of what changes have happened in the economy in the past. I don't see how we could start going back to the gold standard, given all the things that we've talked about and the difficulties that the world faced and which led to the world, abolishing the gold standard. And with the collapse of Bretton Woods, effectively, there was a delinking of gold and money. Let's look at the current period as I go on to finalize, which is run from 1973 to present. Since the breakdown of the Bretton Woods system, international monetary arrangements have evolved in a decentralized system in which countries have chosen to make independent, and I use that in quotes, choices about their monetary exchange rate and financial stability policies. Capital is becoming increasingly more mobile between countries, which is got a problem because that's what led to the 2008 financial collapse, capital mobility across borders. So you see in the developing countries, during the boom phases, there was so much money, portfolio flows, which is short-term money that you cannot really use for development coming into these countries. And when there was a downturn, that money also left, leading to a crash. Let's look at modern times and global trends. International monetary, as I said before, capital has become increasingly mobile. If you look at the, pink line, that's the line that's showing you capital mobility, and you can see that during the gold standard, capital was highly mobile. But then if you also look at banking crisis, there were less crises in there. You can see that now capital is highly mobile, and also there's been an increase in banking, more frequent banking crises, currency crisis, and external defaults. You can see how many banks have closed, since, and all the currency crises that have affected countries like Argentina and, even Zimbabwe as well, under the current system, but also because of this highly mobile capital flow. So if you can look at the stylized view of capital mobility between 1860 and 2000, it's a bit old, obviously, and I haven't managed to update it. Under the gold standard, capital mobility was very high. It fell under the Bretton Woods system. Remember, the Bretton Woods system had specific provisions for limiting or prohibiting capital flows. But since the 1970s, there's been a massive explosion in capital flows. And for the developing countries, it's really been portfolio flows, which we can't use to really develop our economies. Finally, I'm going to then say, well, under the current system, there's perhaps what has been referred to as the trilemma or the impossible trinity. So you can't have a situation where you have free capital flows, fixed exchange rates, and then a country enjoying sovereign monetary policy. So you can have fixed exchange rates and free capital flows, but what that means is that you don't have monetary sovereignty. This is why then, powerful countries like the US can then hit you with sanctions, because the system is sort of integrated. And if you have free capital flow and monetary sovereignty, it means you just have to allow your exchange rate to float. So this is the impossible trilemma. And I don't know how many of you managed to read the paper, which was done by the Bank of England. There are ongoing discussions, suggest that the global financial system must be reformed, especially from point of view of developing countries, because it's not working for us. It just leaves us. The organizations like the IMF and the World Bank were established to help countries like Zimbabwe, especially during times of need. But you have other countries that are more powerful in controlling these institutions, can sanction you. It means you can't have balance of payments support. And under the current system, once you are exposed to that, it means your currency starts to go in free flow. So yes, I'm going to then just conclude by saying, for us to understand where we are in Zimbabwe and our monetary system, we need to also understand this historical background and to understand the global financial system and to understand why sometimes we continue to hear things like, we need to use the gold coins. But, if you don't understand the history of the gold standard, there's no way that you can judge whether the gold coins would work or not. And then finally, to say that I didn't have time to also discuss my chapter, but in my chapter, I was basically arguing that our financial system is intricately linked to our position in this global financial system, which is a subordinate role. Developing countries, they were not even invited to these conversations where, the financial system is discussed, or even if they are invited, their views don't carry the day. And then the argument has been that, we need to have a look at how focus more on the productive elements. As I said when we started, labor is the creator of all value. We should be thinking about where is the value from Zimbabwe coming from? Is it coming from simply people transferring money from the mobile phone to the next mobile phone? So yes, I think with that said, I'm going to stop here and invite questions. I hope you've enjoyed it as much as I enjoyed preparing for it. Sorry that I didn't focus more on Zimbabwe, but I thought that we needed to understand the global picture. And I will send the slides to Comrade Mutasa and he can distribute them to everyone. Thank you very much.
Francis Garikayi.
Thank you very much, Comrade Garikayi, and thank you for that very precise and also insightful historical background on the developments in the financial markets of the world. And as you pointed out at the end, we may need to look at the current developments in Zimbabwe, and if we've got any other additional materials, kindly help us so that we go through, we read them. But to the team, let us give a round of applause wherever you are. Let's thank Comrade Garikayi. And we are opening now to the floor. Anyone who wants to ask a question, as we wait for someone to speak, I want to find out, Comrade Garikayi, what is the relevance of holding gold reserves now? And would you know which countries are holding huge reserves, and what do you think they can use them for in geopolitics or in our engagement as a globalized economy?
Comrades, that's a very difficult question, which I can only offer my, tentative views and thoughts. I think we've started to see, I think, as you said, in geopolitics, Russia, I think, is said to be holding many gold reserves. Venezuela as well had so much in gold. But I think within the current context, I think some countries might be thinking of holding this firstly as a speculative asset, and then secondly, to use them. I think the winds of change are definitely blowing. I don't think that the current monetary and financial system will last for, it's hard to predict these things, but I think there's going to be need for adjustments. And I think countries might be thinking, well, if we hold on to our reserves, if we are part of the BRICS, maybe we might want to transition to another monetary system. And I think this is what I can think of. But whether you would say that you would have more influence because you have lots of gold reserves at the moment, I don't know. Yes, maybe as a speculative assets, you might have some people who want to invest in it or whatever. But I mean, it's not the drive, the move and shake of global trade. If you want to trade, even the Chinese, they have to trade in US dollars. Even the Russians, they have to trade in US dollars. And this is why they've started to face challenges. And this is why the US has so much power anyway, because they print the reserve currency. If you want to trade to sell your diamonds from Chiadzwa, you've got to sell them in US dollars, not Zimbabwean dollars. So it means for the US, it's just a simple exercise. If you are the creator of the reserve currency, just go on your computer and type a few figures. That's how you create money out of thin air. So yeah, I can't say with authority why countries are doing that, but my suppositions are that one could be speculative and the other is anticipating changes in the global financial system.
Comrade Ngandu, you may come on board.
Okay. Yeah, I think.
Yeah, thank you. I'm having network challenges, but I hope you will be able to hear me. I've got two questions. Gaddafi was clamoring about Africa having its own currency, as it were, and so forth, due to the reserves that Africa has in terms of its mineral wealth and so forth and so forth. In your view of such happening with situations where our countries find it difficult on the global markets due to our currencies, not because we don't have the resources, as it were, but because global markets are controlled by, the Bretton Woods institutions, as you say, Americas and so forth, wherein at the end of the day, they end up imposing sanctions on African countries. But if we were probably able to use our own currency, the whole of Africa, without having to probably then rely on European or American currencies, as it were, will then not be able to lose the much exchange losses that arise between countries. Talk about our trade between ourselves and South Africa, Zambia, DRC, Kenya, and so forth and so forth. That's my first part of the question and all contribution. Then the second part relates to the issue of the digital currency, the Bitcoins, the digital currency, and so forth. What, in your view, would be the role or the impact of such digital currency on the obtaining monetary system? And what is backing the digital, what is underlying the digital currency, as it were? You've spoken of the various monetary systems, gold standard, and so forth, and the development up to date and so forth. Then probably just shed more light on the digital currency and the possible impacts. Thank you.
Okay, thank you so much, comrade, and for your contributions. And I think thank you so much for being engaged. That's very good feedback. But look, will not pretend that I have all the answers to these questions. I think some people in this group might have other better views. But yes, I completely agree with you with the view that maybe Africa needs to do something. But I think people who are, these debates are often dominated by people who seem to, Africanists, you may call them Africanists, people who think, well, as Africans, we could do this. But I think if you look at the data, it doesn't support it, how much trade is happening between us as countries? Not much trade, If you then look at the AFCAT and all these things, the free trade area, Africa is mainly selling primary raw commodities to the developed countries, to China and these places. That's the bulk of our trade. If you look at Zimbabwe, for instance, it's a commodity-dependent country. We sell agricultural products and metals, tobacco and gold and these other commodities. Now, if we say we want to have an African currency, that has to be backed by people selling food and all the other important things between ourselves. And sometimes it's not, I don't think we have enough trade within Africa at the moment that would help us to have a currency. Because I think, let's not think about the monetary aspect first. We need to think about the productive element first. Production of things that we can use, things that matter. Because it doesn't matter if you have gold and all these other things, but you can't produce your own food. That's another problem. So for us, yes, it's a good idea to have an African currency, but we need to have more integration of these economies, where we are not net exporters of primary products and big importers of technological goods. So Africans, which African countries are producing technological goods? You need technological goods, the means of production to even mine the gold and do the other things, If we are not producing those things, then how do we become autarkic? So I think it must be more an issue, in my view, of transforming our economies to move away from a dependence on primary products towards more industrializing African countries. And once you industrialize, you realize that then we can then have a better financial system, because money itself is not the solution to this problem. It's often wanted, oh, let's put gold coins, let's put Bitcoin. I think when you talk of digital currencies, I'm sure you're aware that now the cryptocurrencies collapsed completely because, they thought that this was a silver bullet. We circumvent governments and then create money in crypto money, but this has completely failed. Cryptocurrencies turned out to be really some speculative asset that you could buy, and then one day it goes 50 pounds, the next it goes 10 pounds. And this is not the solution. I mean, we are far from abolishing fiat money simply because we are using a state system. You can't create your own money outside the power of the state. We are still all like nation states. The state still has lots of power. We don't have the ability to sort of independently regulate our activities. So in my view, cryptocurrencies, yes, important, but let's not, these are like fads in my view. Let's focus on industrializing our countries and producing technological goods and producing actual things, food sovereignty. That will allow us to have monetary sovereignty, food sovereignty, and energy sovereignty. That will then transition into us having monetary sovereignty. Okay, I'll stop there. And there's another question from the chat box that says, my observation with our current gold coin situation in Zimbabwe, taking it from the history entailed by Mr. Garikayi, somehow they seem to eventually fail. I think I couldn't disagree with that. Imagine the looters we have up there, we have a party with people's forex, people will be left stranded with gold coins and therefore see rejection from the market, even the banks. The world gold coin introduction is a scam in Zimbabwe. Look at what happened to the bond notes being equivalent to US dollar. Yeah, I think gold coins are a speculative asset. I wouldn't really bank too much of it in that regard. But I also think it's related to this whole idea of smuggling gold. There's a need. I think, Zimbabwe is a huge exporter of gold. So I think there might be an instrument for allowing gold to be smuggled easily from, the official. I don't know, but that's my suspicion. I'll stop here.
Right. Thank you, comrade. I think there was another one from Comrade Muwuti. What is the role of gold now in terms of modern assets with the reserves of gold which we have, which is estimated to last for 300 years? What does that mean in the context of growing the economy? With Africa being a resource-rich continent, doesn't this continue to disadvantage the continent because these white nations continue to change the monetary system?
Well, I mean, I don't think it's a racial thing, and I just think that it's an issue of, as I'll go back again, in my view, the silver bullet lies in economic transformation. You know, Zimbabwe was established as a colony in 1890 because they thought that there was gold. How do we explain that several years after colonialism, we are still relying on gold? As I said to you, if you go and look on UNCTAD, Zimbabwe's major exports, tobacco, gold, and other metals. So the economy has not really been transformed to an industrial powerhouse. We need to have industrial jobs, even for our workers. You know, the height of our trade union movement, in fact, the trade union movement, Dr. Comrade Mtase will know better than me, was really vibrant at the time of high industry in Zimbabwe. Once those industries collapsed, the trade union also suffered, you know, because, you know, industrial jobs are quality jobs, not necessarily, I'm an accountant, earlier I was an accountant, not these accounting jobs. I'm not, no offense to accountants because I'm also one, but industrial jobs that equip people with real skills, creating real things, not fictitious things like, you know, money exchange, burning money or whatever. We need to industrialize our economy and move away from simply saying, oh, we've got reserves of gold under the ground, so we should be a rich country. I don't think that helps. No one eats those reserves. We need to be productive on our farms, you know, grow our own food, create our own industries, manufacture our own cars, manufacture our own phones. We are not doing that. The means of production are still very weak. You know, I was reading somewhere else that someone opened a call center in Zimbabwe. That is really a law, you know, a law in our economy to be celebrating a call center. We need to reindustrialize. Only economic transformation will make sure that we are not scattered all over the world or complaining that we have reserves of gold. It is only through industrialization that even the trade union movement will be strengthened, because industrial jobs allow people to be more open-minded, you know. They spend more time on the factory floor creating real things and not necessarily thinking that one speculative asset after the other is going to save us. And it's not a racial thing, I would argue. I think we live under imperialism. You know, even the people in the developed countries, they are also suffering. There's high inflation, cost of living is increasing, but it's because we have a system that is just unfair, you know. So one of the reasons why we can't industrialize is because the developed countries will just won't allow us to do that. They are happy to have us supplying gold and these other agricultural products and, you know, resources, and not necessarily providing the high value products. And they are happy to sell to us the technological goods. So that is the biggest contradiction that we need to resolve, in my view.
Right. So thank you very much. Thank you very much, Comrade Garikayi. I wish to ask a last question, or one more round. In light of the crisis, unfortunately, it's now becoming a global crisis. High inflation, economic instability everywhere. And for Africa, high unemployment, whether you are in the most industrialized country in Africa, South Africa, whether you're in Nigeria, the biggest and most populous country, there is also huge challenge of high unemployment. If you look at the recent ZimStats statistics in Zimbabwe, over almost 73 or 78 youth are not in employment or in training or education or training. And that's a huge, huge, huge figure. In terms of the opening up of the African economies to the globe, in Zimbabwe, talk of ASAP, and in general, the neoliberal policies that came around the 80s and now, the response of most governments in Africa has been to adapt and to basically follow the neoliberal policies and to try and contain inflation within the neoliberal paradigm. Do you think we are going to get out of this? One. Two, what could be the magic wand that is needed? What could be the major policy shifts that is needed? And can that be achieved in isolation of the globe? Can Africa take a different route? Can Zimbabwe take a different route when the world is stuck in neoliberal policies?
Wow, that's a difficult one, Comrade Mtasa, which I think you are best placed to answer. But now that you've asked me for my opinions, I'll gladly offer them. I think, yes, you mentioned really depressing statistics or depressing facts, you know. since the neoliberal agenda has been implemented, we have not only seen the decimation of economies, but the reversal of some of the gains that we got from independence. After independence, we started to have people who were becoming educated, going to school, etc., etc. But now all these gains seem to have been reversed. And I think with the onslaught that's ongoing, it's easy to think that there is no end in sight. But I think eventually it will come to an end. I think the global economy currently is facing major problems. The biggest economy in the world, the United States, capitalism in the United States is not doing very well. There's going to be a recession at some stage, though I don't know when, but that is coming. The 2008 crisis was not resolved adequately. We see this even in economies like the UK. They are changing prime ministers almost every day. It's because the system is not working. So there will come a point when these things fails. But I think the challenge that we face is that how can Zimbabwe then have policies that are different to everything that's happening in the world? I think it's not possible. The global economy, there is some room. So trying to manage inflation, I'm not saying we shouldn't. We should try and do that. But to try and implement independent economic policy, I mean, you'll be punished by the so-called markets, and people. Remember in South Africa, Zuma was trying to do something. The credit rating agencies said, no, this economy is going to be converted to junk status as soon as he tried to engage in independent economic policy. But I think in terms of the solutions, it's important for us to look at what's happened in the past. In the past, we had, in Africa at least, some African leaders who had a vision for Africa. These days, what are our African leaders? What's their vision, We don't have the Kwame Nkrumahs, the Julius Nyereres of this world, who had sort of like Thomas Sankara, a vision for Africa. Today, the vision for African leaders is to attract more investment. Yes, it will help with a few jobs here and there. They get their cuts, a comprador class. It's something, if you want to call it a looting class, but in my view, they are more like a comprador class who are just really like deal brokers, But I think thankfully we still have people like Comrade Mutasa, and we have been in the trade union movement for a long time. And I think when I see groups like this one, it gives me a lot of hope, because one thing that we need to do is to educate ourselves, because if we don't educate all the things I said today, you go to any university in Zimbabwe, they might be covered as a footnote. You go to high school, covered as a footnote. These are not the mainstream ideas that people talk about, SAP, or they'll just say to you, demand, supply, what needs to happen, equilibrium, and they'll just say, oh, the economy in Zimbabwe is not doing well because Mtulingo doesn't know what he's doing, or because there's no mention of some of these constraints that are there. And I think for those in the opposition movement as well, they need to try and do more imaginative. I think we can only extricate ourselves from this mess if we are knowledgeable about what's going on and we invest the time. I'm very happy that most of you managed to do so, say on a Saturday. You could be in a bar, because most people just decide to just drink their lives or watching football, and not necessarily learning about what's going on in the world. It's a distraction that we need to avoid. So the end will obviously come, but we need to also build solidarity, like global solidarity, not necessarily an African view. We cannot isolate ourselves from the world. So if we are a trade union movement, are we affiliated with the other global trade unions? And we should be able to speak with everyone, including those we disagree with. I think that's the other thing is, if you are like left-leaning like me, you don't want to even hear some of the mainstream ideas. If there are means that could sort of ameliorate the pain of our workers, maybe if, for argument's sake, if a different government comes in and gives us short-term relief, that might be useful, It's not an all or nothing thing.